Yo, yo, yo! Let's talk Forex, baby! This isn't just any market. It's the global stage where currencies from every corner of the world are traded. That's the global currency market where trillions, trillions of dollars change hands every single day. Imagine the sheer volume and speed of transactions happening every second. It's like the wildest roller coaster in the financial theme park. The highs are exhilarating, and the lows can be stomach-churning. 1 minute you're up, feeling like a king or queen, riding high on a wave of successful trades. The next minute you're down, wondering if you should have invested in stocks instead. The volatility can be intense, and it's not for the faint-hearted. But hey, that's part of the thrill, right? The adrenaline rush, the excitement of the unknown. It's what keeps traders coming back for more. But just like any good thrill ride, you gotta be smart about it. You need to understand the twists and turns before you hop on. You wouldn't jump on a roller coaster without a safety bar, would you? Safety measures are crucial to ensure you don't get thrown off track. That's where risk management comes in. It's your safety net, your strategy to navigate the ups and downs without losing your shirt. Think of risk management as your seatbelt in the fast-paced world of Forex. It keeps you secure and helps you stay in control. It's all about protecting your hard-earned cash while you're busy chasing those pips. That's Forex slang for profits, my friend. You need to have a plan to safeguard your investments. So buckle up, Buttercup, because we're about to dive into the exciting world of Forex risk management. Get ready to learn how to ride the waves and come out on top. First up, let's talk about stop-loss orders. These are essential tools in the world of Forex trading, and understanding how to use them can make a significant difference in your trading success. These bad boys are like the emergency brake on your Forex trading journey. Just like an emergency brake can stop your car from rolling down a hill, a stop-loss order can prevent your trading account from taking a nosedive. They automatically sell your currency if it starts to tank, limiting your potential losses. This means you don't have to be glued to your screen 24/7, worrying about sudden market shifts. Imagine this. You buy some euros, hoping they'll go up against the dollar. You've done your research and you're confident in your decision. But then, bam! The euro takes a nosedive. Unexpected news or economic data can cause sudden drops, and without a stop-loss, you could be in serious trouble. With a stop-loss order in place, you've set a limit on how low you're willing to go. This is your safety net, ensuring that you don't lose more than you can afford. Once the euro hits that price, your order automatically sells, preventing further losses. This automatic action can save you from significant financial pain. Sure, you might miss out on some potential gains if the euro bounces back, but the peace of mind knowing you've limited your risk is invaluable. But hey, it's better to live to trade another day, right? The market is always there, and there will always be new opportunities. Think of it like this. You'd rather walk away with a few bucks less than lose your whole shirt. It's about being smart and strategic with your trades. That's what stop-loss orders are all about, protecting your precious capital. They are a crucial part of any trading strategy, helping you manage risk and stay in the game for the long haul. Remember, successful trading isn't just about making profits. It's also about protecting what you have. So, use stop-loss orders wisely and keep your trading journey on track. Next up, we got diversification. Now you might be thinking, Trevor, this ain't a retirement seminar. Why are you talking about baskets and eggs? Well, my friend, diversification is just a fancy way of saying, don't put all your eggs in one basket, especially if that basket is on fire. In Forex, this means spreading your risk across different currency pairs. Don't just bet the farm on the euro going up. Dabble in some yen, flirt with the pound, maybe even take the Aussie dollar out for a spin. Why? Because if one currency decides to throw a tantrum and plummet, you got other investments to cushion the blow. It's like having backup dancers for your money. If one trips, the others are there to keep the show going. Now, let's get real for a minute. The most important tool in your Forex risk management arsenal isn't some fancy indicator or secret strategy. It's that 3-pound organ sitting between your ears, your brain. Discipline, my friends, is the name of the game. It's about sticking to your trading plan, even when your emotions are doing the jitterbug. Remember that roller coaster we talked about? Well, emotions are like that friend who screams at every little bump and makes you question your life choices. Don't let them get the best of you. Stick to your plan, manage your risk, and remember, FOMO, fear of missing out, is a real thing, but so is FOMO-induced regret. Section 5, risk-reward ratio, sizing up the odds. Okay, let's talk numbers for a sec. Ever heard of the risk-reward ratio? No, it's not a new superhero movie. It's a way to measure how much you're willing to lose for a potential gain. Let's say you're eyeing a trade with a 1-to-3 risk-reward ratio. That means for every dollar you risk, you could potentially make 3. Sounds good, right? But hold your horses, cowboy. A high reward usually comes with high risk. It's like dating a supermodel. Sure, they're gorgeous, but chances are they've also got a long list of demands, and probably an equally long list of X's. The key is finding a balance. You want a ratio that makes you comfy and aligns with your trading goals. Section 6. Leverage and margin, double-edged swords of Forex. Now let's talk about leverage and margin. These two concepts are fundamental to Forex trading and can significantly impact your trading experience. These are tools that can amplify your wins but also magnify your losses. Imagine them as a double-edged sword. They can cut both ways. They're like those funhouse mirrors. They can make you look really good or really distorted, depending on the angle. The same trade can look like a massive win or a devastating loss. Leverage lets you control a larger position in the market with a smaller amount of your own money. This means you can potentially earn more from a smaller investment. Think of it like borrowing your friend's fancy car to impress a date. You get to enjoy the benefits without owning it. You look like a baller, but if you scratch it, you're in big trouble. The same goes for leverage. If the market moves against you, the losses can be substantial. Margin is the amount of money you need to have in your account to cover potential losses when using leverage. It's a safety net, ensuring you can handle the risks. It's like the security deposit you put down on that borrowed car. It protects the lender, in this case, your broker, from potential losses. Leverage and margin can be powerful tools, but they're not for the faint of heart. They require careful planning and a solid understanding of market dynamics. Use them wisely, my friends, or they'll use you. Always remember, in the world of Forex, knowledge and caution are your best allies. Educate yourself continuously, stay updated with market trends, and never stop learning. The more you know, the better equipped you'll be to handle the double-edged swords of Forex trading. With the right approach, leverage and margin can be your allies, helping you achieve your trading goals. But always respect their power and tread carefully. Section 7. Emotional roller coaster, keeping your cool, when the market's hot or not. Let's be real for a minute. Trading can mess with your emotions. One minute you're riding high, feeling like the Wolf of Wall Street. The next minute you're down in the dumps, questioning your entire existence. That's why keeping your emotions in check is crucial. Don't let greed cloud your judgment when the market's going up, and don't panic sell when it takes a dip. Remember, the market is like a roller coaster. There are going to be ups and downs. The key is to ride out the bumps and enjoy the ride. Section 8. Choosing the right broker. Don't get played. Listen up, rookies. Choosing the right Forex broker is like choosing your wingman. You want someone you can trust, someone who's got your back. Do your research, compare fees, read reviews, and make sure they're regulated by a reputable authority. The last thing you need is a shady broker running off with your hard-earned cash. Remember, a good broker should empower you to make informed trading decisions, not pressure you into risky moves. Section 9. Education is key. Knowledge is power and profit. Here's a newsflash. You don't need a PhD in economics to trade Forex successfully, but you do need a solid understanding of how the market works. Think of it like learning to drive. You wouldn't just hop behind the wheel without taking a few lessons, would you? Luckily, there are tons of resources available to help you up your Forex game. From online courses to trading books to YouTube tutorials, the knowledge is out there. So, do your homework, practice your skills, and remember, the more you learn, the more you earn. Section 10. Backtesting, time traveling for traders. Ever wish you could go back in time and make different choices? Well, in Forex trading, you kind of can. It's called backtesting. Basically, you test out your trading strategies on historical data to see how they would have performed. Think of it like a time machine for your trading plan. You can see what works, what doesn't, and fine-tune your strategy before you risk real money. It's like having a crystal ball, but instead of predicting the future, you're learning from the past. Section 11. Remember, it's a marathon, not a sprint, unless you're day trading. Last but not least, remember this. Forex trading is a marathon, not a sprint, unless you're into that whole day trading thing. It's about consistency, discipline, and making smart decisions over the long haul. Don't expect to get rich quick. Focus on learning, managing your risk, and growing your account steadily. Remember, slow and steady wins the race. And by race, I mean financial freedom. So there you have it, folks, the lowdown on risk management in Forex trading. Now go forth and conquer the markets. But responsibly.